Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. It is March 5th, 2009, and my guest today is Nassim Taleb, author of Fooled by Randomness and The Black Swan, and one of the few thoughtful people alive today who can say, I told you so. Nassim, welcome back to EconTalk.
Well, thank you very much. 2 years later, a lot of things happened since.
Yeah. Now, you have long been a critic of attempts to master risk and the uncertainty of life with mathematical tools. Tell me what you said before this happened and how it has turned out. Where were you right and were you wrong anywhere?
No, my point was that it's not so much a critique of mathematics as much as it is a critique of methods to estimate rare events. We don't know much about rare events by definition because they're rare. Okay, when someone tells you this event should have happened once every 10,000 years, and if the gentleman is not 10,000 years old, you know that he's getting that probability from outside his own personal experience, and the smaller the probability, the more you have to rely on some a priori specification or on a model, on some representation of the world. So my point is that the smaller the probability, the more fragile it's going to be, this estimation, and the smaller the probability in some areas, we're going to have the larger the impact. Look, for example, a 10-year flood has a higher probability than a 100-year flood, but the 100-year flood with a smaller probability will be massively more consequential, and you don't really care about the probability. You care about probability time the impact. You care about the expectation of these events. So small probability events can have in some domains, that last time I called fat-tailed domains, a big impact, and we don't know how to estimate them. We have absolutely no idea how to estimate very small probabilities, and they can be very consequential. So my critique of the models was basically that they relied a lot on some theories to produce small probabilities. And the second one is that these models were very fragile in the tails, of course, but led to the build-up of humongous positions on tail events, calibrated to these theories called value at risk, to these models, to these representation. So the banking system, in my opinion, was extremely fragile. Extremely fragile. Not just the banking system, but anyone who had an exposure to rare events. Some people were robust and some people were fragile. The banking system was fragile. So I claimed in the Black Swan that some companies, after looking at their risk reports, were sitting on a lot of dynamite. And effectively, it ended up exploding a little later than I thought it would, but it exploded nevertheless.
Now, do you think that they were, the thing that fascinates me about this, and there was an article in the New York Times Sunday Magazine by Joe Nocera on value at risk that you were quoted in quite a bit and clearly influenced his thinking. And the idea was that these firms, these investment banks and hedge funds and others, had made their estimates using their models of just how exposed they were to risk, and they turned out to be wrong on two counts. One, the probabilities were probably not right, but more importantly, as you point out, the consequences were what were more important than the odds of the consequences happening. It was the size and magnitude of the effects. So here's my question. If you were the head of Bear Stearns or Lehman Brothers, do you think that they were aware of how much they were gambling, or do you think they didn't care how much they were gambling?
There's a combination. There's actually three things. Number one, if they were fooling themselves. There's some psychological dimension. So people tend to fool themselves into believing a certain story because it fits them. That's the first one. The second one is that they had an interest. Everybody on Wall Street had an interest in building huge risks in a tail for the following reason. If you blow up every 10 years, you're going to make 9 bonuses, and the 10th year, someone will pay the cost, not you, okay? In this case, we have something quite vicious because we taxpayers are paying retrospectively for the bonuses of the first 9 years, okay? So there is a certain incentive to not have insurance against rare events, or even to build exposure against rare events, knowing that you have a high probability of making money any given year, but even if you have massively negative expected return, which turned out to be, look at the expected return from banks. Literally, banks are, as we're speaking, literally insolvent. They've lost more than their capital base, and I mean, Citibank at $1 a share now is not, it tells you it's just at the option value. It has nothing. So they lost everything. But the managers of these institutions have kept their bonuses. So there is an incentive.
Well, not all of them. Some of them were wiped out, right? Some of them have been dragged. Their reputations have been dragged in the mud.
Yeah, because it went a little further than a normal blow-up cycle.
And what about the ones who didn't do it? What can we say about them? They had lower returns year after year than their riskier counterparts, and now they should be doing extremely well. And instead, of course, they're not able to buy up some of the firms that have made the mistakes because the government's propping them up.
Yeah, that was my problem with too big to fail. Is that if we did not save the banks in 1982, because the banks made the same mistake in 1982 and 1991, see? If we did not save the banks, then we wouldn't have or also in 1998 with LTCM, if we didn't save them, we would not have let something very fragile grow to be so large. See, Mother Nature likes to break things early, and capitalism is about failing early, not have some government prop you up. So when you fail big, and you drag a lot more taxpayers with you down.
So you think the moral hazard problem is very real?
I think it started very early in 1982, when banks had the same, very similar. They started, with international lending, and nobody was penalized. You need punishment in capitalism, not bailouts.
Yep.
You need incentives. In life, we need both incentives and punishment. If you have incentive without punishment, someone has a free option.
Yep.
So, but to go back to the story of the risk methods used, I think that maybe bankers were foolish enough to not believe in them. Okay, to believe in them, but you had literally on the part of scientists some, I believe, breaches of ethics. I mean, selling value at risk was, to me, a breach of scientific ethic, because if you test it, you see it doesn't work.
Talk a little bit about what value at risk is and how it was used by these firms for the people who don't understand, who've never heard it before.
Okay, without getting into the details, value at risk gave you there's different methods. There's value at risk, there's expected shortfall, but the value at risk told you, like, with 99% probability you won't lose more than $2 million. The problem it had was that should you lose more than $1 million, the expected loss can be $50 million. You see, and so who cares about just the probability of loss? You also care about how much you can lose if you lose.
Right, and that's what's so striking about this crisis to me, as an outsider, is why didn't you just have a bad quarter? You didn't just have a bad quarter. You got wiped out.
You got wiped out. So who cares about the probability of loss of in excess of $1 million or $2 million? You care about how much you're going to lose when you lose. So the expectation of the loss beyond that, and that's rather intractable.
Don't you think that the people who used those models knew that? That they knew that shortcoming? That shortcoming.
I know. I had a long experience, even before the Black Swan, since 1996, 1997. I used the value at risk in 1993, so started using it, and we had the 1994 crisis, financial market had a mini crisis. I mean, it was definitely, people don't remember it, but it was enough for me to convince me that value at risk was hogwash. It didn't work. So, and that all these claims were just bogus claims, and if these people were monitored by the FDA, they'd be arrested. So, and then I kept warning people, and then people kept bringing strange arguments. To me, there was another big argument against using these methods that rely on the past. And let's look at it as follows. If you're looking at large deviations in the past, all right, and you're in 1987, October, right before the 87 crash, the worst deviation would have had in history is close to 10%, a little more than 10%, negative 10% on any given day. So you would calibrate your value at risk by saying, okay, the worst I'm going to have is close to 10%. And sure enough, we had an event of 23% down right after. So and then now what people have been doing is calibrate to that negative 23% in a given day.
Yep.
So not realizing that if large deviations don't have predecessors, okay, the next large deviation is not going to have the predecessor.
Going to be different. Yeah.
It's going to be different, and it's going to be worse because there's a bias, certain bias. It's too technical to discuss here. There's certain bias, I call it the silent evidence, is that random variables tend to show the rosier paths of the scenarios, conditional on existing. Okay, something linked to survivorship bias.
Yeah.
Now, the fact is that Greenspan, when he went to apologize for letting the banks take so much risk, he said, well, we never saw these events before. But large deviations never have predecessors.
Yeah.
The First Great War did not have a predecessor.
Yep.
You see, the Cold War did not have a predecessor. So you have to take into account the fact that large deviations in history can happen without a predecessor, and it's very easy to be robust against these. It's extremely easy to be robust. Very easy.
What do you mean by that?
To be robust, in other words, you can have two portfolios. You can have one gentleman with a portfolio exposed to rare events, and his brother exposed to the same random variables, but without so much toxic payoff should a rare event happen.
How?
Insurance, okay, now conditional on insurance company existing, or you can construct your portfolio in a different way. For example, I said that the linear combination of no risk, if you can find such a thing, for, say, 80% of your portfolio, and high risk for 20% of your portfolio, is a lot more robust to rare events than an equivalent portfolio on medium risk instruments that would be 100% allocated in medium risk instruments.
Right.
You'd have the same, perceived or variability in both portfolios, but one of them can disappear and the other one will not disappear. Now, the one of them is robust, the other is not robust. Robustness is something extremely easy to build, extremely easy to look at. You just have to abandon these metrics. But people did not want to abandon these metrics. I don't understand.
Psychologically, the right metaphor, perhaps, it's not mine, but I find it very poignant, is the idea of standing on the shore as the Titanic heads off to sea. I mean, it's safe. Come on, get on the boat. That's where the party is. That's where the champagne is flowing. It's very difficult to say, I'm going to have lower returns than you year in, year out, but then there's going to be 1 year where I'm going to trounce you. And that's
that's exactly it. There's another thing that people criticized me when I said I'd rather have 80% of my portfolio in cash. People thought that cash was not an investment. And as we can see from this crisis, what are the securities that performed the best? It's cash.
Yeah, cash is doing pretty well these days.
Yeah, look at it. I mean, with cash, you can buy 10 times the number of wine futures you did last June. You see.
Let's come back to your point about not having a predecessor, because I think it's such a fascinating and deep truth. I think about it a lot because people are saying we're going to have another depression, but of course, possibly. But of course, if we do, if the economy takes a very bad tumble, it will not be like the 1929 to 1946 depression. It's going to be different. It's a once in a lifetime, one of a kind event, and your ability to learn from it might just be limited to the idea that rare things happen sometimes that are not good. But we want to learn more than that. We want to learn all kinds of general principles, and it's one thing I learned from you is that sometimes that's not true.
Yeah, but this is what I mean. This is some form of autism that we seem to have with respect to history, because we don't look at the past in relation to its own past, the way we look at the present in relation, the way it is in relation to our own past. You see?
No, to explain.
To explain, when you look in 1987, okay, you look at 87, what happened, that the worst event was negative, say, 11%, and the next one was negative 23%. You see? You don't transfer the same analysis to today. You don't say today's past, the worst event was 23%. Right. Therefore, the next worst event can be 50%.
Be 50, yeah.
So what I say, if you take today's past, today's future, you see, and then our past, date in the past, its own past, its own future. You see, we don't transfer this analysis. So it's a form of autism, and it may increase with the use of mathematics, because cab driver would understand the point. Simple traders would get my point. I don't understand why someone with a PhD in economics or financial engineering would somehow fail to understand these points.
Well, part of it is hubris, right? Part of it is, I am told, I don't know if this is true, but I'm told that some of the ratings agencies did build into their forecasts the possibility that default rates on housing would reach levels of the Great Depression, which would seem to be very, very safe then. Because what could be worse than that? I mean, after all, haven't we learned something since then? How could we possibly have rates worse than the Great Depression? But of course, we can.
Of course we can. The fact is that bothers me the most in this, that exposure to these tail events was preventable.
In what sense?
In what sense? If you take the divisions in banks, let's not take the general debt level in the economy, because that causes an exposure to tail events. Let's just take banks. Where they lost the most money was marginal. They lost on subprime initially, and then on other areas that were not particularly profitable. I mean, were profitable, but not. They kept pushing the envelope in them. They're getting less and less profitable, and they increase the exposure.
Yeah, a friend of mine in the hedge fund business said he could never figure out why anybody bought those senior tranches of those of the collateralized debt obligations, because the return wasn't high enough. Yeah,
they were making pennies.
I wonder what the story is there.
Pennies. Well, they got pushed into the pennies. I remember before LTCM blew up, it was the same situation.
This is long-term capital management.
Long-term capital, exactly. We had a blow up in 1998, and anybody who still used value at risk after 1998 there's a problem. He needs to have his head examined, because these events in 1998 should have convinced you that these bubbles, these crises happen very fast, that you can have tail events, that you have contagions, that correlations go to 1, that all the models cease to work when you need them to work, and that we should not bail out the banks, because we should teach the banks to be have a little more discipline. Okay.
Yeah.
And at that time, I remember those who blew up are those who had positions that made pennies at the margin. It was like there's a cycle. People take the most risk when there's the least return. And someone, I remember, I think Jim Grant was calling these things returnless risk. You see, not riskless return.
Yeah, fascinating.
It was a very interesting episode in history, and surprisingly, we kept building risk in the economy after that, particularly starting in 2001, 2002 with Greenspan's Novocaine. And the most disappointing thing was Ben Bernanke calling the era after 2001 of low volatility, calling it the Great Moderation, and providing, of course, analysis of why we had a great moderation. He didn't realize that what we call the tails were getting fatter. In other words, volatility was compressed, but the contribution to the risk coming from jumps was increasing.
Yeah, I mean, I think he was referring to the longer period of 1982, say, to 2007, but still,
it encompassed that period that had low volatility.
Of course, he's a central banker.
He's a central banker.
He
didn't realize the system was getting more complex, and the complexity started rising in 1995. And the risk of cascades increases with the internet.
Why do you think complexity was rising after 1995, or why do you say that?
The internet, fads. Look at the book like Harry Potter. Okay, if you take let's say that an environment that doesn't have complexity is an environment that doesn't produce large-scale events. Okay, it's not a definition of complexity, but it's okay. The more tail events, the more complexity. All right. So in before the internet, you couldn't spread cultural ideas very fast. After that, we started having like the Harry Potter effect. We started having the whole planet reading the same books, listening to the same music, and we started having planetary-wide fads.
And as you point out, I think it's in the Black Swan. Maybe it's fooled by randomness. That leads to very large right-hand tails for a very small group of people, right?
Exactly. Yeah. I mean, it's right-hand tails for a small group of people, but also it's tails. I mean, it could be negative tail for someone with the exposure, but you have concentration. I start looking at concentration, not of wealth, but say of income for people in some professions, sports or the arts, and of course you have fewer and fewer people making a larger and larger share of the pie. And that's came with that complexity, okay?
Talk about that again, because I love the example you give in one of your books about the local opera singer who performs at weddings.
Yeah, if you have, say you have no globalization and absolutely no way to store your voice and no internet and no CDs, an opera singer in southern Italy, a very mediocre opera singer, will have his audience because people aren't going to go to Milan every time they want to listen to an opera music. They can't even listen to music without someone singing in front of them, you see? So he will have a business. He will have a good business. Now we have a gramophone and, of course, later on, the internet.
So why should anybody listen? Yeah, you get perfect reproduction. Technology lets you hear anybody you want with perfect quality.
Exactly. So why should you listen to that poor guy? And he's lucky he's going to get bookings for birthday parties, and the whole planet will have a handful of opera singers making the bulk of the income,
making a huge amount of money.
Huge amount of money, and other people will struggle, and we see that in literature. You see that in a lot of things. Where I use that comparison with the income of a dentist. A dentist cannot store his work. He cannot leverage his work. He cannot scale. He cannot scale it up.
Right. The world's greatest dentist is limited in how many people he can see in 24 hours.
Exactly. So you use massage professional, same thing. He has to be there to deliver his service. Whereas an opera singer can be dead.
Yeah.
You see? So, or a writer. Every time I wrote in my book, The Black Swan. When you bought it, you didn't call me up to, write, or the publisher didn't call me up, say, write this book, someone wants to buy a copy. It's just they print what they got. So information, the more informational economic life is, the more it can deliver large deviations. That's sort of the idea I had.
Which is very good overall, by the way. I don't want to paint this as just disaster. There are many wonderful things about it. You get great opera singing.
If you know that it reduces predictability, it does provide. I mean, you have to expect to see spikes. You can see spikes because a dentist can have spikes in his daily work, or if they exist, they're going to be not very accentuated, but sales of a record can have spikes.
Yeah.
Or download a record can have spikes. So a complex system has other attributes, you see. But given the existence of spikes, you need to be protected from these spikes if you have an exposure. So you can get very rich if you're on the right side, but you can blow up very easily if you're on the wrong side of these spikes.
Especially if you're leveraged.
Especially now leveraged. So this is why I thought that, this is after the black swan, I started looking at leverage. And I realized that complexity cannot tolerate leverage anymore because there's no room for error. And not only that, but we had since 1980 a considerable increase in leverage in the U.S. and in Europe, about 3 times tripling of leverage. The ratio of leverage to GDP. If the numbers are right, this is this is shocking. So you have a high exposure now to errors in industries everywhere. People in their personal life, banks have high exposure to errors, coupled with a rise in complexity means the world can deliver large deviations.
Very quickly.
Very quickly. And we see that in commodity prices as well. You see, a similar argument. You can use a similar argument to show why you can have a rise in oil prices or a rise in wheat prices. So such a sharp rise in response to a very small imbalance in demand, followed by such a rapid collapse. We're now in early March. Not long ago, we were talking about inflation.
Yeah.
And now people are talking about deflation. So
we're going to come back to inflation, I think. But, the speculative issue in commodity prices, I don't think we fully understand it. I wonder how much of it comes from the same mistakes of Mr. Greenspan and Easy Credit, and I'm not sure.
But I think there's also something else, that people talk about globalization, not realizing that globalization has side effects. And let me, I'm trying to find a good argument for it that I should publish, next 3 or 4 months. A mathematical argument, why globalization produces fat tails. But the casual explanation is as follows. In a competition, you remember I was talking about 2 banks, one making $2 a share, one making $1 a share, no? One robust, one non-robust, two tail events. So with the globalization, everybody is going to be pushed to do, say, the outsourcing in Bangalore or some similar place. So you're going to have a concentration of U.S. and German and French firms outsourcing to Bangalore. So it's going to have much cheaper costs.
Yep.
Okay. And the probability of having a problem in Bangalore is low, you see. So odds are they're not going to have any disruption. So you'd have sort of a lower probability of failure or lower probability of problems with IT among these firms because you have only one, say, source of randomness. I'm idealizing. Of course, it could be other places in Bangalore, but I'm idealizing. I'm say all of them did their IT in Bangalore. Now, suppose there's a problem in Bangalore.
A political problem, say.
Any problem in Bangalore. Political problem, that there's a
hurricane,
storm,
flood,
something, whatever, okay? That disrupts communication with Bangalore. What happens to all these firms? See? So we, in a way, are not as diversified as we were before.
Correct.
So you have exposure. So this is why you have I use the same example with a story of a French bank called Société Générale that lost a lot of money on a rogue trader. And I said that the problem is that if you had 10 banks with 10 small banks with 10 rogue traders, each one of them having 5 billion hidden position, you wouldn't have a problem because if they catch you with 5 billion of hidden position, that's rather easy to liquidate. Now we have one bank with a probability of having a rogue trader, so you have 1/10 of a probability of having a rare event, say a rogue trader. That should it happen, his position would be 10 times the size because the bank was one bank 10 times the size of the other banks. Okay.
Okay.
Now, the assume that you have nonlinearities in execution costs. Liquidating $50 billion is vastly more costly than 10 times liquidating $5 billion.
I believe that.
In other words, that lumping, the fact that you have concentration among banks, it's a drive for efficiency. That lumping makes you more vulnerable to rare events, more vulnerable to errors.
Well, and the costs of when the errors occur are much larger, too.
Exactly, because one large error is a lot worse than 10 smaller errors.
So where does
spread over time?
So where do we go from here? These are all important lessons, and we're not going to learn them because the government's not going to let people pay those prices.
My problem with the government is that I prefer nationalization of whatever you need to nationalize to bailout, because in my idea is that the government doesn't understand that you don't give heroin to a heroin addict because he has withdrawal symptoms. You should stop the problem early, not late. So by propping up institutions that are very weak, you're making the problem worse for the next time around.
For sure.
So I don't know. I don't know what the government should be doing now, but in my idea is that whatever is fragile should break as early as you can.
But that is not the political incentives.
It's not the political incentive. The second point is about governments, that people ask for more regulation. And I say, okay, I don't like regulation for the following reason. Value at risk was implemented because the regulators wanted it. So they made a mistake. I mean, the regulators bought the banking system. Do we not need more regulations? People are going to go around it. I'd rather have something government-owned than regulated. Smaller piece of it government-owned and the rest unregulated. Whatever we may have to bail out one day, I'd rather own rather than be forced to bail out someday.
Yeah, the problem is, I'd be for that up to a point. I mean, in theory, I prefer nothing owned by the government, but if you're right, if we had a choice between bailout and ownership's probably better. The problem is they can't keep their promise to not bail out the other part.
Yeah, that's the problem. It is because when you're dealing with governments, you have all these diseases of dealing with governments. You're dealing with civil servants and you're dealing with politicians, and both have very different incentives from you and I.
Yeah.
And of course, they like regulation because the regulators gain some powers. They like regulation, and I'm very surprised that in all this argument in Washington, nobody spoke about the role of regulation in bringing this crisis. This crisis was caused by regulators. With the rating agencies, regulators helped rating agencies spread their ratings.
Ironically, it seems to me, we put a lot of pressure on banks to hold their assets in the form of AAA, which of course increases the return to producing AAA assets. And so it's not surprising to me that there was a big premium put on making sure that your asset was AAA. That is definitely part of it. I don't know if that's enough.
Yeah, no, that's part of it. But there's other things like I think pension funds could not hold segments of the portfolios in some categories.
What else? What other role do you think regulation played in creating the problem? What are your thoughts on Fannie Mae?
I'm looking at it. The one I'm most familiar with is value at risk.
Mm-hmm.
I was familiar with the rating problem to a lesser degree, but the value at risk is to me, is like crime against every form of scientific knowledge we have, and regulators like value at risk
because it's a number.
It's a number. Yeah, it makes everybody's job easy.
So, what do you think is going to happen? Do you think we're going to continue to live in this fantasy of we can create a riskless world?
I think that eventually what's happening, that we're discovering that You can get. I mean, no government is big enough to save large banks. We're discovering it now. You see, so it's a hard way. So I think the system is going to break whatever is fragile, no matter how big it is, and no government can save it. We're seeing this problem now with AIG.
Yeah, AIG.
And globalization is creating a more vicious problem, which is that nobody knows which government should get involved in what.
Yeah.
You think that the failure of Swiss bank should not be a concern to the U.S. taxpayer?
Yeah.
And these UBS has more assets over here than it does over there.
I think Gordon Brown was here yesterday in Washington, and I think he talked about stabilizing all the banks. Just a great idea. Let's have every insolvent bank propped up. What a brilliant strategy.
Well, it looks like, the nation state, as you can see, the globalization has another side effect from the one I mentioned earlier, which is that the nation state ceases to exist. People have no control. Governments have no control over these things they can control. They're all acting the same way.
They still have control over my pocketbook, though, and that's the main...
And that's, in a way, they don't have control over what they think they would like to have control over.
It's a really interesting issue, because that is what they still maintain, through the physicality of where I live and earn my money. The tax system remains the bread and butter of the nation state.
That is unfortunately true.
So what does the future hold for Nassim Taleb, a prophet who has seen to be right, but he remains somewhat unheeded as the future unrolls? So what do you see your where's your highest value, my friend?
No, I think I'm in a way I was involved financially in this crisis, so I said, okay, they're not going to listen to me, so I went back to trading after finishing the Black Swan. I was involved financially, and now I'm going to be more of a philosopher. And I think that I don't want to be heated. It's okay. I would like to be heated, but I don't need it that much. It's okay. The ideas are out there. They should spread. I think that with a couple of million books, a couple of million copies, a small minority will understand the points and spread them. And my contribution to society is going to take place in the form of people being conscious of the need to be robust to these large deviations. And now I'm moving on to my other projects.
And so tell us a little bit about those.
It's always linked to probability, but to me, we don't make decisions based on true-false. True-false...
heads, tails.
Heads, tails. Epistemology is about deciding whether something is true or not true. And typically, this translation in statistics is you set a confidence interval and you say with 95%, this is true, that this drug works, or so on. But we don't make decisions based on true-false. We make decisions based on payoff and based on some other judgment, because even when we sort of know the payoff, we don't quite know the probability, so it's very fuzzy. We don't really use probabilities in decision-making. And the ones who were aware of it were the ancients, as usual, because the ancients did not use probability. And when we discuss probabilities with a modern person, they think in terms of this is true, this is false, and this is a probability. But the ancients, for them, it was much fuzzier. It was more of a decision-making tool, and probability came from Cicero, who coined the word in his beautiful treatise. And for him, probability was something you approve of, regardless of the odds, what we today would call the odds. So, for example, would you drink water, from a glass left on the table by a stranger? No, you would not. But do you have evidence that water is going to hurt you? No, you don't have evidence, but you're not going to do it because it's not something you approve of. So this is sort of the line of work I am following now. A decision-making under uncertainty without using probabilities. Something a little more complicated. And this is bringing me to a whole new way of thinking about do what we do versus what we know. That what we know is not quite relevant. We do things in a certain way. I think in economics, of course, that brings me closer to Hayek in a way.
It's very Hayekian.
Very Hayekian, and it's taken me into the history of medicine everywhere, and it's taken me into an area extremely anti-academic, anti-knowledge. Because we humans have always been messed up by knowledge. And I have data, and then the history of medicine is a beautiful proof of that. Is that whenever we use knowledge as a driver rather than tinkering, we got in trouble.
Can you give some examples?
Sorry?
Can you give some examples from the
history
of medicine?
The history of medicine. There's an argument used by Le Fanu with data, but you can see it in a lot of other places, that shows that our understanding of the biological processes led to a decrease in cures. That when we're tinkering, just going randomly, looking for things, we did a lot better than with directed research, because our understanding of the underlying process, of course, it's incomplete. It gives us a very strong bias. And blinds us to things we don't quite understand and we don't know are there. So tinkering and trial and error worked beautifully in the past, and we're able to produce a lot of cures. Now the cure rate has slowed down. Although our knowledge has been growing exponentially, particularly since we know we have the DNA.
Yeah.
And that's an example. Another one is, of course, you can see it in medicine. That typically most medicines are used to cure something completely different from what the original intention was.
Yeah, that's very interesting.
So side effects dominate. So what you do when doing something like that is tinkering, is try to collect positive side effects, positive black swans.
Yeah.
So it's all part of the same package of how to live in a world we don't understand. The ancient knew how to do that much better than the modern.
And we suffer from the hubris problem of overestimating our knowledge.
Exactly. And there's some places in which it can be very harmful, say small probabilities, where this overestimation of knowledge is going to be very high. But there are a lot of other areas in which it can be harmful as well.
Well, one thing I've learned from you, from your books, which I think is a profoundly useful and important thing, is just how difficult it is to think rationally about probability and uncertainty and risk. And it's a huge part of the human experience that most people are intimidated by, and so they tend to they trust the science part, and they let other people, talk about the risk. So they ask their doctor, what they should do, as if the doctor knows the probabilities. The doctor has no idea what the probabilities are. Every person is different. Every treatment is different. Every disease is a little bit different. And we need to reclaim those things for ourselves. And we need to be able to think about them.
Yeah, in my book, I have my heroes, the empiricists, who wanted to do the maximum they could without theories. That was, you always have to have a theory in life. You have to have a theory of how a book looks like to hold a book, all right? But the idea of the empiricist is to minimize theories, minimize the harm coming from theories, minimize claim, a generalization. It's like everything is new, everything is different. That was and empirical doctors were extremely successful until they were completely eliminated with the rise of Arabic medicine. And that was rationalistic medicine, and Western medicine was rationalistic after the Arabic tradition, until we had the recent improvement in medicine coming not from the doctors, who were always rationalistic, but from the barbers and from the surgeons who were barbers.
It's really
they were not theoreticians. So the history of medicine is extremely rich. If you're looking for these arguments. That thinking has not helped us a lot. But again, it's not just there. I found evidence in a lot of places. The one closest to me is option trading. Everybody thinks that quants make option formulas, therefore the market uses them, and it's turning out to be bogus. we have been using option trading formulas, not option trading formula. As you well know, as Hayek would tell you, it's not some theoretician setting up the price of goods in the supermarket. Okay, it's supply and demand. and supply and demand prices convey information. It's the reverse. So option prices, we knew how to trade options in a vastly more sophisticated way, and started in 1870. And my friend Espen Hogg and I have been looking at how people priced options in the past. We did a lot better before they had Black-Scholes formula.
That's very interesting.
So here we have evidence that theories are getting us in trouble. But everyone on Wall Street thinks that we need quants to price options, not realizing that what quants are doing is observing price formation and trying to fit some formula on top of it, something epiphenomenal.
Yeah.
And whenever we listen to them, guess what? We get into trouble.
Well, it's also very much in the line of pragmatism, a philosophical school that we've talked a little bit about on the show before. This idea that Descartes was a little bit dangerous because he thought reason could triumph over everything. And the pragmatists were interested in, again, very Hayekian way of trusting what had emerged from trial and error as being wise. And it's hard to accept that, but that may be the right way to go.
It is hard to accept it, but what I'm doing for my next piece of work is a very general thing. Like the Black Swan, historical, but also I'm compiling data. I'm trying to provide data showing exactly that universities had negative contribution to knowledge compared to practitioners.
Could be. I hope not, but could be.
I mean, I know that university in technological areas and a lot of areas. So that was what happened is that lecturing birds how to fly, and then later on claiming credit. Say, here, look at it, the bird's flying. You know, it's listening. You listen to me and followed my equation. That's sort of like the idea I'm following in my next book.
Well, I saw an interview with Peter Singer, the philosopher at Princeton, where he said it was probably okay for people to genetically choose smarter children because, after all, intelligence makes the world better. And I thought to myself, not so sure. It depends on what kind, where they are, and what they're doing with it, I suppose.
Yeah, definitely. Plus his definition of intelligence. I don't know how people define intelligence. If succeeding, what people call IQ, I'm more and more convinced that IQ notion of IQ is number one local, it applies to one individual, and two, it applies, exam taking.
A very important skill between the ages of maybe 16 and 23. We have a little bit of time left. You want to close and say something about religion and probability?
Most people think that religion is about belief. And again, using the same line of argument, Dick Naver's episteme, I just realized that religion was about practice. You cannot trust humans with knowledge. You got to tell them what to do, and religion helps a lot. And I learned that, you see, I'm Greek Orthodox, but Arabic speaking, from a Near Eastern Levantine tradition. So I wondered, at some point it hit me that the way Arabs say "I don't know" is not "I don't know." You know how they say "I don't know"?
No.
God knows.
Uh-huh.
So it allows you to say "I don't know."
Right.
And just that reason, okay, makes religion very potent in taming our hubris.
Mm-hmm.
By saying that there's God knows. You don't say "I don't know," you say "God knows." You're transferring it away from your own person to some other. So in other words, you're constantly, you can allow yourself to be humble because you're not humble to another man, you're humble to God, to another entity.
Your religion.
So that's one function of religion, okay? But there are other functions of religion. I got this from the history of medicine. There are numerous, maybe about hundreds of accounts of people, say, giving their fortune to the temple of Apollo by telling Apollo, listen, you saved me when my doctors failed me. All right? And I realized that this argument, but given that doctors up until very recently killed more people than they saved, that you really had negative contribution, particularly when they bled you. You know that.
Sure.
And again, even when they knew that bleeding did not necessarily help, they kept doing it because that was the thing to do.
Or when they delivered your baby after coming from the morgue.
Yeah, I mean, things like that. So the doctors, particularly it peaked actually with hospitals in Paris, with a death rate from going to the hospital. So doctors had negative contribution. I just realized that anything that took you away from a doctor to satisfy your illusion of control was good for you. And there again, religion, if it's just neutral, okay, it was helpful.
You're ahead.
Any religion, just going to the temple of Apollo. So I realized it took you away from a doctor. So that's another function of religion. And so I've been analyzing or looking at this error we have in believing that religion is about belief. And no, religion is about commitment, is about the system, is about living in something, because our beliefs, in the end, get us in trouble. We're not good with ideas. We're not yet good with ideas. And as we can see now from this crisis, we're not anywhere close to getting acceptable ideas.
The great moderation turned out to be not so great.
Exactly.
And so, and what does probability have to do with it, with religion? It's
still this idea of true false. Probability, I link it to the idea of what is true and what is false. You see? It's a degree of belief in that the statement is true. That's the way I handle probability in that. I say that you may think that the odds you may do something against the odds.
Because the consequences are sufficiently
large. Because the consequences are large, and because, or some, even without analyzing it. So there are two things. Number one, probability is very opaque. We don't observe it. It's not an object. And two, even if it were something tangible, we wouldn't use it. It would be completely swamped by the consequences. I mean, that's sort of like the idea of Pascal's wager that keeps coming back. Taking the concept beyond, generalizing it to about everything in decision-making.
So Pascal's wager is, since God might exist, I may as well be a religious person. Exactly, because the payoff from being religious is much higher than the negative payoff from being religious. If God exists, is much higher than negative payoff if God doesn't exist. So you have nothing to lose. It's sort of like a free option. That's the idea in Pascal's wager. But I mean, this is a very simplified argument, and it's very naive, because you have to also assume that God would exist and not know about your gaming the system. You see? Well, he might be just happy to see in some religions, actions are more important than beliefs. So you're okay there. You can be a hypocrite in some religions and still get lots of credit because you do the actions, even if you don't believe them. Yeah, I mean, it's a notion of hypocrite in the Greek Orthodox religion. If you ask a monk what is being Orthodox, tells you fasting and celebrating Easter and doing this and doing that. That's the definition of religion. Well, in Judaism, Maimonides, who listed the commandments, as did others, not every Jewish sage lists belief in God as one of the commandments, because there is a debate about whether you can mandate belief. And for some, it's just enough to do the commandments. Whether you believe them or not is not so important. That's right. I mean, I've been trying to read the ancient texts, and I realized that the name for religion in Arabic, deen, is a name for law in Hebrew. Yes, that's correct. So, I mean, to be religious and it would mean, in Semitic languages, to be a law-abiding citizen. Yeah. That's it. Keep the rules. Yeah, keep the rules. That's it. So this is my idea of religion. But I think it's harder to keep the rules if you don't have the faith. So it is faith connected. Maybe something comes after. But, in a lot of periods of history, some people said that we just need the faith because people cannot be motivated otherwise. Yeah. Well, we're doing. But then again, it comes back to I'm losing patience with people who are skeptic about religion. You see, and at the same time, who are not skeptical about economics or value at risk. You see. Well, if you worship man, if you don't believe in God and you worship man instead, you're more likely to think that we can solve our own problems, right? That's not a coincidence, I don't think.
It is not. And everything since our last conversation, this is bringing me back more and more into it's making me, I read Hayek, after 15 years, and I just realized this man had a lot of instinct.
Yeah, he's a smart guy.
He is. It's probably his contributions will someday be part of the philosophical thinking.
Well, I'm thrilled that people still heard of him. We're getting there.
We're getting there.
Well, my guest today has been Nassim Taleb. Nassim, thanks again for being part of EconTalk.
Oh, thank you very much. Thanks a lot.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.